The monsoons, deficit rainfall in select areas, hardly a cause for worry as rural India received normal monsoons on time and with widespread distribution, says Ramesh Iyer of M&M Financial. In fact, let's hear him out. He had a conversation with Shraddha Babla earlier today.
It's important to understand, at least from an overall perspective, a deficit of 5-7%, how impactful is that? I think more important is, was the monsoon on time? Was it widespread? Right. I think these two have been a great support when it comes to what the yield is likely to be. But of course, within the state of Maharashtra, there could be one or two pockets. In a state of UP, there could be one or two pockets. But I don't think one needs to over-focus on them and be worried about, are they going to be significant?
So, what typically happens in a post-election year? It's easy to understand that there would be a slightly higher demand, good repayments as far as the pre-election year is concerned. What happens post? What have you observed historically?
So, typically when someone buys an asset during the election times, they normally buy it for just 2 years of borrowing. And they kind of repay within that period. So you don't really see defaults arising out of those purchases, while the overall buying can be very, very high. And that's been historic. We've seen it state after state. You will also see many people who've been running a little slow on their repayment. Their asset gets better deployed, and therefore the overall repayment improves, because the overall cash flow through activity in that geography improves. So I think it's always been a very positive trend.
But then what happens to growth in the post-election year then? I mean, does that get depressed?
So I think it's important to look at the kind of assets we finance. They are all earn and pay segment customers, and they are all commercially deployed assets. So definitely, yes, the growth rates do come down a little if you were to compare to the election year. But there is always a minimum buying that happens, and then these becomes an additional volume during that period, which is why you will not find anyone over-resourcing themselves permanently during this period. So we would not add substantial number of people on a permanent basis. So we will kind of move them across from our own branches and help them meet the demand during that period. So definitely the growth rates do come down, but the minimum volume stays.
So overall, what do you really think could put a brake to this solid CV demand that we're seeing right now?
I think if for too long you don't see too much of infra activity pick up, or you don't see productivity or production goes up and therefore the goods movement kind of gets curtailed, or for some reason the railways get extremely efficient and people start moving through railway, as otherwise I think the commercial vehicle growth is here to stay.
Right. Sir, we were speaking about acquisitions, and you said that a portfolio or asset buyout would make more sense for you than buying out a company by itself. But then even in that case, what are the kind of assets that you're looking for? Will it be more to do with your housing finance business, your asset management business, or what are the areas where there is a possibility of considering?
As you know, we are in vehicle financing, tractor financing, pre-owned vehicle financing, and of course asset management and housing. As far as the vehicle family is concerned, I think we would be happy to look at commercial vehicle, construction equipment, because that's where our base is low. Whereas in tractor, we have a very strong base. But if we were to get a large tractor portfolio, someone who wants to exit tractor business, we wouldn't mind looking at that. So any vehicle family assets available, we would be keen to look at. Clearly on the housing front, we would not look for a very urban asset, because that's not our strategic intent. We would not do business in urban. So if there is semi-urban, rural housing or an affordable housing piece available, we will for sure look at. Similarly, in the asset management also, we would not look for a very high urban-based liquid assets and things like that. We would rather look for retail assets beyond the semi-urban market. If somebody wants to exit a business and offer a portfolio, we would look at. So I think geographically, we would look at semi-urban, rural kind of a portfolio. By asset class, we will look at retail assets, and within the vehicle and tractor family, we would be open to all.
All right. So also bond yields are now back to 8% than your 4-year highs. I understand so far you've been passing on all these higher costs of funds to your customers, but is there a capacity or capability for them to absorb further rate hikes?
So typically what happens is, up to a certain level, let's say 50 basis point, the financier does pass it on to the consumer. Sometimes 25 basis point gets absorbed by the financier themselves if the volumes are adequate. But just imagine a situation that the volumes are adequate or the demand for vehicle is very high, but interest plays as some kind of a dampener if at all. Then the OEMs and the dealers do step in and they start picking up some cost as well. So at some stage it can so happen that the financier and the OEM and the dealer picks up the cost and the consumer is not made to pay for all. And certain percentages the consumer also pays for. So if 100 basis point was to be divided, I would imagine 50-60 basis point the consumer would pick up, another 30-40 basis point could get shared.